Hello again, this is Robert Schein, Managing Director and Partner with Blanke Schein Wealth Management. Well, today is May 5th. Happy Cinco de Mayo, and support your local Mexican restaurant. Hopefully have a good takeout dinner tonight from them, and maybe a couple extra margaritas to boot. But today let's talk about three topics again for all of our clients, friends, and family out there that are following along and watching us on a daily basis. We truly appreciate all the support. We thank you for your feedback, and feel free to share this to friends and family that you want to keep on a sort of a daily update as to what the markets are looking at, market observations that we have, insights, again, all of our resources that we're using here, HighTower, that we have available from our capital markets. We get to see sort of everything Wall Street has to offer and more. So let's talk about what we're three topics today. The first topic actually is pretty interesting. It's an article from Wall Street Journal, and it talks about home prices are rising during the pandemic. How is that even possible? Well, if you look at it, in the middle of February, when everything was a government mandated shutdown because of COVID-19, even early January, the numbers that we saw from the National Association of Realtors were showing a couple of things. Number one, at that time we had rates, again, really low. We had housing inventory at all-time lows. In fact, one of the things that they were describing in the article that was published in the Wall Street Journal was specifically talking about how inventories were at a 5-year low, meaning the housing market was undersupplied. Now, of course, things have changed recently. We probably will see an uptick in supply, but nevertheless, year over year, home prices are rising across the United States. In fact, even in the article, they point out that only 4% of the listed properties have even reduced their prices as they're going to ride this out firmly. I think we've got a lot of things even working for housing that are positive going forward. One, rates were low in February. They're even lower now because of what the Federal Reserve has done and the lending rate. So check, if it's time to refinance, it might be a good opportunity to do so. So let's look at this a little bit deeper. So according to the National Association of Realtors, in this Wall Street Journal article, the total listings hit a 5-year low across the United States. So the total number of homes for sale are completely undersupplied. So what we know about supply and demand is when supply is short and demand is still there, prices rise. So we did see an uptick year over year across the United States, and some more than others in different markets. Everything, obviously, real estate's local, but we did see a move to the upside in the real estate market, okay? We're continuing to see that. Now, there was 1.5 units for sale at the end of March, and the supply was down 10.2%. So let me restate that, because headlines are going to be talking about real estate is down by 10% in the end of March. And what they actually mean is the supply is down by 10%, okay? It's a very big nuance. You'll see headlines talk differently, and they'll frame it differently, talking about real estate is down. The supply for real estate is down 10.2% at the end of March, according to the National Association of Realtors. So it's important that we see through this. Markets are seeing through this. They really are. They're extremely strong right now. So I think it's important to keep your eye on this. And then mortgage rates are all-time low once again, depending upon what kind of mortgage you're looking for and shopping for. So anyway, that's an update from the real estate market side. I think it's a really good article in the Wall Street Journal. Check it out. So the next topic I'm going to talk about are the three curves to be watching. Essentially, the first one is what we were talking about in terms of infections in COVID-19. We're seeing that on our daily news cycle, so I don't have to spend any time on that one. And that curve itself has gone down, right? So we hit the bell curve as all the medical professionals have described for us. So that's on the decline. So there's two other curves that we want to talk about, which is number one, the jobless claims historically high, but are they peaking? So take a look at this. This is a curve of what we're showing and reporting for our jobless claims in the United States. And what you're noticing here is that that's also following a pattern. Now, again, the headlines are going to report, and obviously being unemployed is tragic, and we've got some policies in place to help those that are unemployed, even boosting the additional support on a monthly basis right now going forward for those that are unemployed. which is all a positive, that the economy and the government's come to assistance. But the cumulative total, right, 23, 26 million, could get up to 30 million. The cumulative total is what's going to be reported in the headlines, but the curve itself is now on its way down, meaning the initial claims are going to be less, or the rate of increase is going to decline, if that makes sense. So let's look at the final curve that I think is important as it relates to, what the market's looking at, what we're constantly monitoring. This is another positive trend that we're seeing as it relates to this curve, this bell curve, if you will. It's Barclays index of investment grade corporate spreads to treasuries. And essentially that's saying, how much more yield will you get if you're investing in investment grade corporates versus US treasuries, which is backed by the full faith and credit of the United States. So it's more risky to be investment grade than it is to be in US treasuries. And so as this curve steepens, or the basis point stretch, that's showing a sign of greater risk or stress within the fixed income markets. Well, going back in the middle of March, it did peak, and now we're on the backside of this important spread, or the curve that we're watching here. So as we get closer to May, right now it's only at 207, and we started at 96 basis points, went as high as 373 basis points in that spread. But I keep talking about or mentioning the fixed income markets. Fixed income markets are sort of easing their tension, and that's important. So the liquidity is there. The Federal Reserve has done its job, keeping all the market makers guessing of what they're going to do. But ultimately, it's bringing that curve down. So the three curves that matter, that's what to keep an eye on. So finally, we're looking at the economy, and the economy is going to have a, whether it's a Nike swoosh, a recovery as I described earlier, or a square root, or a U-shape, V-shape, W. We don't know. But what we do know is we're going to set up for a good third quarter bounce. I think there's enough liquidity in the marketplace, as I described before. Corporations are sort of weathering the storm. Again, the small business owners need some help, as well as those that are unemployed. That being said, what the markets are looking at is, and for the economy to be sustainable going forward, again, the travel industry and a few other things, the entertainment industry, those are going to suffer, multi-year damage as it goes forward. But in the short term, what really matters as it relates to the economy, as it relates to a sustainable opening as we reopen, is it's going to be the schools. The schools are key, and why that matters is simply because over 40% of households in America that have 18 or under, basically child and school age kids. We've been able to manage this short term last 2-3 months, but going to the fall, everyone's going to be reopening and going back to business as usual. And if the schools aren't open, or there's not a possible safe place for childcare for our schools, then we're going to have fits and starts in the economy. That's where it's going to be a big challenge. So 40% of the U.S. households right now are dealing with that. We are as well. I'm just blessed to have my wife at home with the kids, and kids are studying and doing their online learning. So that's all working well, but how sustainable that is for the long term, that's going to be a real key that the markets are looking for, and that's what we're keeping our eye on in terms of how we go through this summer. Thank you for watching today.